Hello everyone, thanks for checking out my video. The stock market saw some strong gains last week as investors continue to navigate an evolving global trade landscape, while major tech names got a boost with the buy the dip crowd stepping in. Google's parent company Alphabet rose 1.5% on Friday after it reported an earnings that beat on both top and bottom lines. Tesla, meanwhile, saw its share price jump over 13% in just 2 days, even though it posted a massive double miss on top and bottom lines. Sometimes I wonder if Tesla is selling cars or selling dreams. Just kidding. Anyway, we have got a big week ahead. 4 out of the magnificent 7 tech giants will be reporting their earnings. Plus, we have key data releases such as the US PCE index, GDP, and the jobs report. So do stay tuned throughout the video to find out more. Alright, so major US indexes and stocks rose last Friday as investors got some positive news from Trump's generally optimistic tone on trade talks, and Fed officials hinted at possible rate cuts as early as this summer. The latest rally was driven by big tech, with all of the magnificent 7 stocks posting gains last Friday. Tesla led the charge as it popped close to 10% in a single session and around 18% over the past 5 trading days. Other mega cap names like Nvidia, Meta, and Microsoft also ended the day higher. As a result, the S&P 500 notched its 4th consecutive gain on Friday, marking its longest winning streak since January this year. On the trade war front, Trump claimed there was progress in his negotiations with China, but then China came out and denied that any such talks were even happening, insisting that the US must first lift its tariffs. In short, China said there were no ongoing discussions about a trade deal, even as the US appeared to have softened its stance. Okay, despite the mixed signals and unclear who is actually telling the truth, the market took the news positively, probably because it looked like Trump has blinked first in the trade war that he started. Just to add, Trump also mentioned that he expects several deal announcements over the next 3 to 4 weeks. Personally, I will take his words with a pinch of salt, and I think the market does too. But still, the stock market rallied, likely because it is a sign that Trump could be backing off a little bit. That said, don't get too excited yet, we are definitely not out of the woods. I will touch more on this later in the End Thoughts segment. On a side note, the market also responded positively to Trump's sudden change of tone towards Jerome Powell. Not too long ago, he was criticizing Jerome Powell for being too slow to cut interest rates, and even hinted at firing him, which would have been a major challenge to the Fed's independence from political influence. But then, last week, Trump backtracked and said he had no intention of removing the Fed chairman. Classic Trump flip-flop. What's new, right? Just like how markets dipped on the initial news of potentially firing Jerome Powell, they are now rallying on his decision not to fire Powell. For the upcoming week, it is going to be a jam-packed week as the latest rally will be put to test. First of all, investors will be focusing on a wave of corporate results led by the big tech. Meta and Microsoft are set to report their earnings on 30th April, Wednesday. Amazon and Apple are scheduled to report their results the next day, 1st of May. Investors can expect tariff uncertainty to be a crucial topic for upcoming corporate reports. On the economic data front, 3 things to watch: an inflation update, data on the first quarter of US economic growth, as well as the monthly US employment report. The March reading of the PCE price index, a key inflation gauge closely watched by the Fed, will offer fresh insights into whether inflation is cooling off or sticking around, and could significantly influence expectations for future interest rate moves. In addition, the monthly US labor report, which will be out on 2nd May Friday, could provide the biggest test for the stock market for the upcoming week. Why so? Because labor data is a key indicator of the health of the economy, and more importantly, it heavily influences the Federal Reserve decisions on interest rates. If the report shows strong job growth and rising wages, it might suggest the economy is running hot, which could push the Fed to keep interest rates higher for longer to fight inflation. On the other hand, a weaker than expected report might raise concerns about an economy slowdown, but could also increase hopes for rate cuts. Either way, it is a crucial data point that could swing the market sentiment in a big way. Moving over to the next segment, technical analysis, SPY, which represents the broader market, is showing a little bit of positivity. As you can see, SPY has started its retracement up and reclaimed 3 Fibonacci levels in the process. Notably, it has closed above the so-called pivotal 50% Fibonacci level at around 547. That's definitely good news. But here's the but. We have a few key hurdles ahead. The first one is this gap between 551 and 544. This gap used to be bigger, but SPY has filled a portion of it last Friday, so watch the price action this week. If we don't have major negative news this weekend, then SPY could fill the entire gap. When that happens, we need to watch if it starts to pull back, because sometimes after a gap filled, sellers may step in. That being said, once again, if no major negative tariff news, I'm actually expecting SPY to test that all-important 61.8 Fibonacci level at around 562. This level is extremely important because other than the Fibonacci level, this is also where the 50 moving average is, as well as the blue resistance level that I drew. With these 3 levels converging together, I would call this a triple resistance level. If SPY can break above this level, the whole market could fly. But honestly, my opinion is I will remain cautious, or rather I think the odds of SPY breaking above this level this week is pretty low. I could be wrong though. Anyway, I'm expecting sellers to step in at either the top end of the gap or the 61.8 Fibonacci level. Even if they don't step in, we still have a huge resistance at the 200 moving average, which now sits at 570. Anyway, it doesn't really quite matter when is the resistance coming or where the sellers step in. The more important thing is, if we have a pullback, will the 50% Fibonacci level hold? This level is at 547. If it doesn't hold, then the short-term trend is still bearish, and it also means last week's rally was just a relief rally. When that happens, don't be surprised if we feel the gap at the bottom, which is between 529 and 533. Next up, let's check out Apple's chart. Just like SPY, Apple is now trading near the 50% Fibonacci level at around 210. We have either tested or went near this level twice recently, but failed to close above it. This will be the 3rd time. Well, 3rd time's the charm. If let's say Apple starts closing above this level, then I would expect the momentum to bring Apple to fill that gap between 212 and 221. Within this gap area, there is a huge and critical level to watch, and that is 220. This is where the so-called golden 61.8 Fibonacci level and the 50 moving average are. If somehow Apple can go above this level as well, wow, then I do think we could easily hit 227 where the 200 moving average is, or perhaps even test 230. Again, similar to SPY, if a pullback comes this week, the bulls would want the 50% Fibonacci level to hold, which is around 210. If we start closing below 210 and that green support line at around 206, then I am expecting both that small gap ups to be filled. This means we could see Apple below 200 again. And from there, watch carefully how Apple moves. If we get a bounce from either of the gap area, that's slightly bullish. But if it doesn't bounce, then we can say hello to 180's range again. Moving over to Tesla. Wow. Tesla is really one rare stock where it missed its earnings terribly, and yet the stock price went up more than 13% in 2 days. Amazing. Like I said at the start, I do wonder whether Tesla is selling cars, selling robots, selling AI stuff, or are they simply selling dreams? Maybe it's all of the above. Anyway, I got to admit I was wrong about the MACD. Tesla once again had a bearish crossover on MACD and reversed it quickly. This is the reason why one should never be too fixated on a particular thesis, whether it's bearish or bullish, and always stay nimble. When trend changes, you got to change with it. Right now, obviously, Tesla is swaying towards the bullish side because the share price has punched above the green zone that I drew. Not just that, it has also closed above the 15 moving average. These are all positive signs. But yes, here's a but. If you zoom out the chart, you can see that Tesla is still trading within this consolidation zone, which stretches from around 214 all the way to 291. And coincidentally, 291 is where the pivotal 50% Fibonacci level and the 200 moving average are, which forms a double resistance level. Which means we are not out of the woods yet despite last week's strong 2-day rally. But if somehow Tesla can reclaim that 200 moving average, then we could easily see Tesla back in the 300s range, testing the critical 61.8 Fibonacci level at 309. This level is also one huge resistance level where the share price had difficulty going above previously, back in August 2022. Just to add, if somehow and somewhat there is a solid good catalyst for the company this week and it managed to clinch that 309 level, wow, this stock could fly very high, at least till the 320s range. Okay, but that's a little far-fetched in my opinion. Let's bring ourselves back to earth. If Tesla gets rejected at any of the heavy resistance levels that I mentioned, watch for the green support zone, which is between 264 and 272. If Tesla starts closing below this zone, we can easily say hello to 240s range again. Okay, at the end of the day, as long as the recent low of 214 holds, the bulls don't have to worry too much. However, if 214 breaks, which means if Tesla starts to close below 214, it's waterfall time. Alright, moving over to Google. Well, Google's chart looks interesting. Last Friday, the share price attempted to rally after it reported a pretty superb earnings. But as you can see, that red candle shows that sellers stepped in during intraday to push the price down. That candle also shows a rejection by the 50 moving average and the 38.2 Fibonacci level at around 166. This, to me, is not quite a good sign. The share price is currently sitting right above the green support zone that I drew a few months ago. I personally think that this zone will be tested this week, which means that tiny little gap between 159 and 161 will likely be filled. At the green support zone, the bulls would want Google to bounce, because if it doesn't, that means the trend is still bearish and there is a decent probability that we will fill the second gap between 152 and 153. And again, if we don't bounce from this gap, it's a bad sign, and I do think the bearish momentum will bring Google towards 140's range again. Okay, on the other hand, if Google can hold above that green zone, then better still closes above the 50 moving average at around 164, that means the bulls are back in the game. A close above 164 will almost naturally brings the share price towards 174 to test the 200 moving average and the pivotal 50% Fibonacci level. To be honest, unless we have really good news from Trump with regard to trade deals, I think it's quite tough for Google to go above 200 moving average these 2 weeks. I mean, such strong earnings from the company already saw the surge faded away in just one day. I think it speaks a lot of volume about the current bearish trend. Alright, let's now move over to Meta's chart. Meta is looking not too bad, but just like many other stocks, it is not out of the woods yet. It's looking decent because the MACD just had a bullish crossover. On top of that, we had bounced off the 480 level again, forming a potential bullish double bottom pattern. But don't be too happy yet, because we are still at a very preliminary stage of recovery, and we still don't know if this is a dead cat bounce. Nevertheless, Meta has taken the first baby step forward by entering the green zone and even closed above the first 23.6 Fibonacci level. To be honest, this means nothing in the current climate. We need more bullish signals to show a trend reversal. In other words, Meta needs to go above 579 to show that the bulls are back in the game. Because by closing above 579, Meta would have closed above the 200 moving average, which is an important moving average to clinch in order to reverse the bearish trend. But for me to call Meta bullish, it needs to climb further up and go above 610. By doing so, it means Meta has also reclaimed the 200 moving average as well as the 50% Fibonacci level. If that happens, it's probably the first Mag 7 stocks to do it, and that's when I will say Meta is bullish. On the other hand, a fall below the green zone would mean that last week's rally was a dead cat bounce, and we can expect to fill that gap between 506 and 516. If it doesn't bounce after the gap fill, then please be prepared to see Meta falling below 500 again. Moving over to Microsoft. By the way, is anyone watching this segment? Because I saw in my YouTube stats that the viewership for Microsoft dropped a lot here. If no one's watching, I may consider removing this Microsoft segment because my video is really too long and it takes a lot of time to prepare. Okay, anyway, let's check out the chart. Microsoft is about to hit a level of heavy resistance, which is around 396. This level is formed by the pivotal 50% Fibonacci level and that green line that I drew, which I'm not sure if you could see it on screen. Just to highlight, we went near to this level twice previously and got rejected. Let's see if third time's the charm. But if it gets rejected again, then I think there is a decent probability that Microsoft could decline to the gap area between 367 and 373. If it bounces from the gap area, great. But if it doesn't, then we might see 350's range again. In terms of the bullish thesis, if Microsoft bounces up from the gap area, it's a small sign of bullishness because the share price would have created a series of higher lows. Just to add, who knows, maybe we don't get a retracement this week and Microsoft continues to stay above the 50 moving average, and that's a positive sign. But if Microsoft can close above that 396 level, then I do think 408 could be in sight soon, as that is where the 61.8 Fibonacci level is. Alright, last but definitely not the least, Nvidia. Nvidia's chart actually looks pretty straightforward to me. It is basically moving within this purple downtrend channel. As per the previous occasions, it has bounced off the bottom of the channel and is moving towards the top end of the channel. And there is a likelihood that it might get rejected anytime when it crosses the mid channel. So for this week, watch two key levels at the top, and they are the 50 moving average at around 115 and the 50% Fibonacci level at around 120. 120 is also the top end of the channel. I personally would expect heavy resistance at either of these levels, but if I'm wrong and if Nvidia can close above 120, that will bring the share price out of the downtrend channel, and that's bullish. On the other hand, if Nvidia gets rejected at either 115 or 120, don't be surprised if it drops to 100 in the blink of an eye, because that's where the little gap is between 99 and 102. Below the gap, we do have a little support at around 96, but again, I wouldn't be surprised if it breaks below this 96 level because Nvidia is just following the recent pattern of moving within the downtrend channel. Which means if Nvidia does retrace below 100 this or next week, don't get caught off guard if we hit 80's range again, because that's where the bottom of the downtrend channel is. Okay, let's move on to the options trading section. This week is interesting. I want to show you how I am not a guru. Yes, you heard it correctly. I know there could be many options guru out there, but I am gonna be transparent and show you I am no guru. Anyway, 4 trades to update this week, which are all summarized on this page. So the first trade is the one that will expose me as a non-option guru. It's a cash secure put on Microsoft. So what happened was that last Monday, 21st April, the entire stock market was falling, and specifically for Microsoft, it fell to 350's range. My strike price for the put option was originally 375 and the contract was expiring on 25th April, Friday. At that point, the MACD just had a bearish crossover and the share price was around 20 points away from my strike price. The overall market looked really shaky and I wasn't confident that Microsoft can recover that much in 4 days. Furthermore, my contract went into the money and there is a high risk of early assignment. And so I decided to roll the contract down and out. The new put contract has a new strike price of 362.5 and a new expiration date of 16 May. But lo and behold, the market had a wild reversal, and by the end of the week, Microsoft had gained 30 points to hit the 380s and 390s range, way more than the 20 points that I would have needed. Which means if I hadn't rolled the contract, the earlier contract would have expired worthless and I would have been able to keep the full premium. So yep, this shows that I'm just a normal and grounded options trader, not the gurus that you might see on the internet. Sorry to disappoint. Anyway, with the latest rally, the trade is up quite a fair bit now, but I can't really lock in the profit at this point because this contract was wrote once before the latest roll. I will explain more when this contract expires in May so that I don't confuse the viewers here. Moving on, the second trade is this cash secure put on Tesla with a strike price of 140, which expired last Friday, 25th April. This contract was sold on 12 March. During that period, Tesla has already crashed more than 50%. The RSI has hit the most oversold level in over a year. So, theoretically speaking, a short-term rebound should likely happen. I actually explained a little more in the previous video, so you can check it out if you wish to. I have linked it at the top right hand corner. Anyway, I selected a pretty safe strike price of 140 because the odds of Tesla falling another 50% was pretty low in my opinion. I mean, you just do the math. From its peak of 488 to 140, that's more than 70% crash, which I think is quite unlikely at this point. So after I sold the contract, Tesla went on to move sideways and the share price did not even break below 200. As such, this contract expired worthless last Friday and I got to keep the full premium of around 215 without having to close the position. Next up, I'm just gonna go a little faster and shorter here. The third trade to update is this cash secure put on Tesla with a strike price of 260. This contract was wrote twice previously. The original strike price was 300, then it got wrote to 272.5 and finally to 260. And as of last Friday, which was the expiration date, this contract expired worthless as Tesla closed above 260. The profit for this trade is as shown on the screen, around $330. Just to add, the very first contract was sold on 16 January, which means it took me slightly over 3 months to close or end this trade. And I still managed to walk away with a small profit of $300+ after deducting the transaction fees. Not bad, right? Okay, the last trade is also another position that I have wrote previously. It's this cash secure put on Google with an original strike price of 160 and I had wrote it down to 155. As of last Friday, which was the expiration date, this contract expired worthless as Google closed above 155. The profit for this trade is as shown on the screen as well, around $180. So as you can see, I try to be as transparent as possible with my viewers. The last two trades didn't go as planned and I ended up rolling them to buy more time and to get a more favorable strike price. I think it's actually a good opportunity for you to follow along during this volatile period so that you can see how I manage my trades when things don't go my way. Alright, before I dive into my thoughts on the current stock market, I have two quick updates to share. First up, I have received my 4th paycheck from YouTube, so a big thank you to everyone for the support. It's not a huge amount, about $170, but I'm really grateful. And as per my usual tradition, I have donated the entire amount again. This time around, the donation went to the 365 Cancer Prevention Society. As highlighted on their website, every year, countless individuals in Singapore face the challenges of a cancer diagnosis. I'm sure the physical and emotional toll on both the patients and their families are very overwhelming, and I hope this small gesture can go a little way in supporting them. Next up, the second update, and that is I have turned down a brand collaboration. The offer came from a brokerage firm which I think many of you would have heard of the brand, though I won't name the company here. They basically wanted me to promote a new feature that allows users to trade stocks and only settle the payment later, or essentially trading on credit. It's a trade now, settle later concept where investors can buy and sell stocks without pre-funding their accounts. And to me, that's a form of leverage trading, and I think that can be quite risky. So as you can see from the email I sent them, I decided to give this opportunity a miss. I personally feel that trading on the credit limit carries high risk, especially for retail investors who might not fully understand how it works. Therefore, I do not want to promote this feature to my viewers. To be honest, even if they are going to pay me thousands of dollars, I am just not gonna do it. Alright, so why am I sharing these two updates? First, I just want to let you know that by watching my weekly videos, you are indirectly supporting good causes. So far, I have donated every single dollar from the YouTube AdSense to charity organizations. Okay, but to be clear and transparent, I am only referring to YouTube AdSense income. For other types of revenue like referral fees or brand collaborations, I do keep them. But as you might notice, I don't really get a lot of all these deals, aside from Longbridge. That's the one and only so far. And as you can see, I just turned out a deal from a company bigger than Longbridge. There goes my second collaboration. But it's okay, that brings me to my second point. I want to stay as real and as transparent as possible for this channel. I don't want to take money to promote things that I don't believe in or products that I don't personally use. And being transparent also means I will continue sharing how much I earn from YouTube AdSense, how much I donate, and even show you all my options real trades, the wins and the losses, all in the name of honesty and transparency. So if you appreciate this kind of spirit and want to support the channel, I would be really grateful if you could just give this video a like or even share it with your friends. These actions cost you nothing. And if you're on the lookout for a new low-cost brokerage, then feel free to check out Longbridge using my referral link, which I admit I do get referral fee, just like how you would get one for referring credit cards or platforms like Shopback, Shopee or Haymax to your friends. Okay, back to the stock market. Wow, that was fast. Just 2 weeks ago, the S&P 500 nearly closed into a bear market, which is defined as a 20% decline from all-time high. But a new shift in market direction and sentiment has been happening almost as quickly as it started. Over the last 12 trading sessions, there have been lots of bigger than usual moves in the stock market, boosted by easing tariff talk and trade policy. As of the time of recording, the S&P 500 had finished at a level 10% higher than its recent low, marking a swift recovery that almost brought the index out of the correction territory, which is defined as 10% of the recent high. Personally, I think after weeks of uncertain tariff news, the market seems to be finally stabilizing a little bit, or perhaps the market has gotten used to the flip-flop style of President Trump. Yes, we do have some mixed messaging around trade negotiations between US and various countries, but as long as the momentum of these trade deals and talks are swaying towards positive or neutral, the market shouldn't plunge too much. The price could stick around the current range for a while until the next major trade catalyst is announced. Okay, in case I'm not clear, we are definitely not out of the woods yet. The trade war is far from over. The stock market will remain sensitive to tariff news of the day, so don't only expect upside from this point onwards. Investors should continue to brace for more twists and turns on trade until July, when the 90-day pause in tariff is up. Alright, amid all this chaos, there is probably one takeaway for us, or at least for me, and that is stock market rewards patience. With the whipsaw movements and roller coaster rides in the recent weeks, investors should know by now it's difficult to pinpoint a market bottom. Therefore, what's important for investors is to have a plan, be patient, and stick to the plan. The patient and disciplined investor usually gets rewarded over the long run. Remember, I shared with you guys that I wanted to get Nvidia shares if it falls below 100. I did it. I was patient and I stuck to my plan. In addition to that, I also set entry price targets for stocks like Microsoft, Meta, and Google, and each time they drop to my price, I step in. As of the time of recording, all of these stocks are giving me decent returns based on their current share price. But of course, in the short term, the market could still go down from here, and I have already gotten a plan for that, which is to step in again at my new target prices. My point here is you have got to be patient, you have got to be disciplined, and you have got to be less emotional. Even if after you purchase your stocks, the share price could continue to drop, so be it. You gotta trust the process and the company that you invested in will recover in the long run. Unless you are near retiring age, most investors with long-term goals and horizons should see a market correction or crash as a buying opportunity while stocks are on fire sale. Alright, that's all for this video. Next weekend is the election weekend here in Singapore. I was thinking, should I take a break and chill, or should I continue to produce this weekly video? Let me think about it. Meanwhile, do help to like this video, alright? Thank you very much.